Welcome back to our channel. Today we're diving into the exciting world of options trading. If you're new here, make sure to subscribe and hit the notification bell so you won't miss any of our future videos. Now let's unravel the mystery of options trading. So, what exactly are options? In the stock market, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an asset at a specified price before or at the expiration date. Remember, every one option contract holds 100 shares. Example, if the option contract costs 35 cents, reality, it's 35 cents times 100 shares, so the cost is $35. In the money refers to an option that has intrinsic value. For a call option, this means the market price is above the strike price. For a put option, it's when the market price is below the strike price. Next up, out of the money. This is when an option has no intrinsic value. For a call option, the market price is below the strike price. And for a put option, the market price is above the strike price. At the money is when the strike price and the market price are the same. Speaking of strike price, this is the predetermined price at which the buyer of an option can buy or sell the underlying asset. Lastly, open interest. This is the total number of outstanding option contracts in the market at any given point in time. Remember, understanding these terms will help you navigate the options trading landscape more effectively. So take some time to familiarize yourself with them. Now let's talk about the two primary types of options: call and put options. Call option gives you the right to buy a stock at a specific price, the strike price, before the expiration date. It's like reserving the right to purchase shares at a set price in the future. The advantage of call options is the potential for significant profits with a relatively small investment. However, it comes with the risk of losing the premium paid if the market doesn't move as anticipated. On the other hand, a put option grants you the right to sell a stock at a predetermined price before the expiration date. It's like having insurance against a potential drop in the stock's value. Put options provide a hedge against market downturns, but like call options, they come with risks. If the market doesn't move as expected, the premium paid for the put option may be lost. Every option contract has an expiration date. This is the date by which the option must be exercised, or it becomes worthless. It's crucial to keep track of expiration dates when trading options. Exercising options. When it comes to options, you have two choices: exercising the option or letting it expire. Exercising means you're using your right to buy or sell the underlying asset at the agreed-upon price. This is typically done closer to the expiration date. Alternatively, you can let the option expire if it's not favorable to exercise. Option premium. Now let's discuss the concept of the option premium. This is the price paid to buy an option contract, influenced by various factors. These factors include the current stock price, the current strike price, the time till expiration, and market volatility. All of which can be noted by understanding the Greeks of option trading. Greeks are statistical values that represent these factors in trading. They include delta, theta, gamma, vega, and RO. These measures help traders assess risk and manage portfolios effectively. Understanding these Greeks is vital in options trading as they help traders assess the risk and potential reward of an option. In options trading, Greeks are statistical values that throw light on how the price of an option might change in the market, given certain conditions. These are used to assess risk and manage a portfolio of options. Delta measures how much an option's price is expected to change per $1 change in the price of the underlying asset. It's a measure of the option's sensitivity to changes in the price of the underlying asset. Gamma, on the other hand, measures the rate of change in delta for each $1 change in the price of the underlying asset. It's essentially measuring the speed at which the option's price is changing. Theta represents the rate of change in an option's price for each day that passes. This is often referred to as time decay, as it measures the rate at which an option's value erodes over time. Vega measures an option's price sensitivity to changes in the volatility of the underlying asset. A rise in volatility increases the option's price, while a decrease reduces it. Lastly, Rho measures the sensitivity of an option's price to changes in the risk-free interest rate. This Greek is less commonly used but still important in a comprehensive risk assessment. Understanding these Greeks is vital in options trading as they help traders assess the risk and potential reward of an option. Now, for all you beginners out there, let's briefly touch on some basic strategies to dip your toes into options trading. The covered call involves selling a call option against shares you already own. This is typically when you own 100 shares of a particular stock. It's a conservative strategy that generates income. Although you generate immediate income worst-case scenario, the option does not go in your favor, and you have to sell your shares. Next is the protective put involves buying a put option to protect your stock holdings from potential declines. Remember, options trading can be complex, so start small, educate yourself, and consider paper trading. Firstly, the most glaring risk is the potential for total loss. When you buy an option, you risk losing the entire amount you invested if the option expires worthless. Remember, this can be alleviated by adding a stop loss to limit your losses. However, options trading can also offer significant rewards. The primary advantage is the leverage it provides. With a relatively small amount of capital, you can control a much larger amount of an underlying asset. This leverage can magnify your potential profits, but it can also amplify your losses. Another risk lies in the complexity of options trading. Unlike traditional stock trading, options involve more variables like time decay and volatility, which can make them harder to understand and predict. It requires a good understanding of financial markets and trading strategies. On the reward side, options can provide a strategic advantage. They can be used as a hedge against potential losses in other investments, and they also allow you to profit from market movements in either direction, or even when a stock price remains stagnant. Lastly, options trading is not suitable for everyone due to its speculative nature. It's important to thoroughly understand your risk tolerance and investment goals before diving into options trading. Remember, this is just the beginning. Options trading is a vast and complex field, and there's always more to learn. So, continue to educate yourself, practice your strategies in a risk-free environment, and never stop learning. It's also important to remember that while options trading can offer significant potential rewards, it also carries substantial risk. Always make sure you fully understand these risks and are comfortable with them before you start trading. We hope this guide has provided a solid foundation for your options trading journey. Remember, the key to success in any form of trading is knowledge, patience, and discipline. So keep learning, stay patient, and trade wisely. Until next time, happy trading.